Growth seeming to be rising steadily in the country. We've got some, though, questioning the credibility of these numbers and whether it's reflective of the economic picture on the ground. What's your view?
Well, the question of data integrity in Nigeria has always been a question. And recently we've had some debate about that. But what we've tried to do is to use some proxies either to validate or repudiate these numbers. The question today is that the proxies, the divergence between the proxies and the nominal data is beginning to narrow. Actually, we are seeing some convergence in this. So the numbers this quarter seem more valid than the numbers in the first quarter.
So let's take a look at what actually is propelling growth at the moment.
Yes, the office says that agriculture is driving it, and there's an improvement in agricultural activity, but there's significant underemployment of agricultural resources. The other thing is that the linkages between the variables and the sectors in Nigeria are pretty weak, so you don't feel the impact of a nominal increase in growth right now. But on the other hand, you must see the fact that some of those variables are actually steady but on the low side. The most important one is that the oil rig count is up to 12 all the way from, in fact, up to 16 all the way from 11 last quarter. The value of checks cleared has held stable at about 1.2, and it has actually grown by 22% in the last month. And we've also seen some stability and momentum in the stock market as well. The stock market is obviously a leading indicator of growth activity as well.
At the same time, Bismarck, we've seen the Central Bank of Nigeria and Bank of Industry, along with various other commercial banks in the country, put pen to paper yesterday to execute a 500 billion naira deal to fund the power and manufacturing sectors in particular. This in efforts to revive those spaces. What have you made of that and that kind of stimulus now coming to the fore?
Well, 500 billion naira as a percentage of total risk assets is minimal. But it's symbolic in the sense that it shows that, and it goes to the bottom of the pyramid in that particular sector of manufacturing. So it's going to be 1 or 2 billion naira across maybe 200 players who are the weakest link in the chain, and that will help to reactivate some activity there. But it also sends a signal to alter economic agent behavior in the sense that lenders will begin to come out of the woodwork and begin to lend some more. When you put all of this together, where monetary policy begins to complement fiscal policy, I think in the long run it's going to drive that process. You will also see that inflation is tempering down. It's at about 10.4%. But the big 800-pound gorilla in the room is the exchange rate and the external reserves. The external reserves are down to 38 billion. They're down almost 12% in the last quarter. And that is going to be a real challenge going on next quarter.
The risk, of course, being that the level of cushioning is not exactly very comfortable moving forward. What's your outlook in that regard and the ability to build those reserves as we move forward?
Well, that's the problem. You see, you can't make omelette without breaking eggs. The issue is that the Nigerian reserves are being used to intervene frequently and in terms of volume into this foreign exchange market. A point will have to come where the Nigerian monetary policy authorities have to make a decision. One, if you are going to depreciate this currency, are you going to go one fell swoop, or are you going to go by the crawling peg? That's the decision that will be a subject of the conversation at the next MPC meeting. And I look forward to having that conversation with the governor and other parties in an open forum.
Well, we've heard mention of bond issuances in Q4 expected to move higher to the figure that's been put out there, 315 billion naira from 240 billion naira in Q2. What's your outlook in that regard and bond issuances being driven higher?
No, the bond market, the strength and the volume of the bond market is critical to any economy. I think what has happened recently, the Security and Exchange Commission, as you know, has moved against the broker-dealer community to minimize, in fact, to eliminate infractions in that market, to sanitize it and restore investor confidence. The truth is that major corporates are all looking at the bond market. So you're not just going to have bond values, but you're going to have bond diversification. You're going to have corporate bonds across sectors. You're going to have state government bonds. You're going to have municipal bonds. And you're going to have federal government bonds. The impact of this is that as the demand for fixed income securities increase and the yields begin to get into equilibrium, we will see a yield curve that will emerge that will lead to a much more efficient and probably a sophisticated money market in the long run.
Where diversification of that money market is the key thing that we're looking at right now. We know, when this trend emerged over in Kenya, the concern was that government bonds would start drowning out, some of the corporate bond issuance coming to the market and raising capital via this route. Do you see, or do you have any of similar concerns over in Nigeria?
I think the market is not that deep, so there could be initial crowding out, but I think that is also a functional and positive thing in the sense that it will create for an effective equilibrium price. Right now, I think the interest rates are artificially low, and they will come back to some, not that they will go back to the stratospheric levels of last year, but they will definitely move maybe 200, 300, 400 basis points up to get some kind of equilibrium, where the price of money will not only reflect the demand-supply situation, but also the risk in the market.
Well, just a quick look at some of the news on the capital market scene at the moment. Nigeria's Securities and Exchange Commission said this week that it's taking 260 entities and individuals to a special tribunal over alleged market abuses committed between 2006 and 2008. Of course, this is being done in an effort to improve investor confidence in the country. What have you made of that move, and have there been any further developments on that front?
No, I think it's a great move. The new DG of the Securities and Exchange Commission has zero tolerance for infractions. It's sending a clear signal. It helps to stabilize the market and cleanse it so that will-be investors and existing investors can have the comfort that the market is now transparent and that the activity levels there will begin to grow. Without that, it was open season between 2006 and 2008. It was, there was a culture of impunity. And it was a free-for-all. This has stopped under the new leadership and focus and direction. And we'll look forward to greater days ahead.